They told you the banks were untouchable. They told you silver was controlled. They told you squeezes don't happen in commodities. But today, JP Morgan just bled $2.4 billion, and the scariest part? This wasn't an accident, it was math, and it's not over. Because what just happened in the silver market wasn't a rally. It was a trap snapping shut. Pause for 1 second and understand this. Prices don't move like this unless something underneath the system breaks. And today, something did. Silver didn't climb. It teleported. And when that happens, someone is forced to pay. That someone was the biggest paper short on the planet. For months, there was a number everyone whispered about: $65. The invisible ceiling. The line bank swore would never fall. Every rally died there. Every spike was smothered. Paper contracts dumped like confetti to keep silver obedient, until it wasn't. Because when silver punched through 65, it didn't hesitate. It surged. Algorithms panicked. Liquidity vanished. And the price ripped higher so fast it exposed something the banks never wanted you to see. Fear. But here's where it gets interesting. The pullback that followed wasn't weakness. It was confirmation. If you're watching price alone, you missed the real event. This wasn't retail buying. This wasn't hype. This was forced buying. Here's what actually happened. Banks sold massive call options betting silver would stay below 65. As long as price stayed capped, they collected premium and smiled. But once silver crossed that level, their risk didn't rise linearly. It exploded. Every dollar higher multiplied their exposure. Computers took over. Risk models flipped from manageable to emergency, and the only way to survive was to buy silver futures aggressively, regardless of price. Not because they wanted silver, because they had no choice. That's a gamma squeeze. A feedback loop where buying causes more buying until someone breaks. And today, the banks blinked. Silver spiked. Sellers disappeared. Machines chased price upward in pure panic. Then humans stepped in. Profit takers sold into the vertical move. Algorithms cooled. Price pulled back slightly. And this is where most people got misled. You've been told pullbacks mean failure. That's wrong. Pullbacks after breakouts are how markets prove the move is real. Old resistance becomes new support. 65 wasn't a ceiling anymore. It became the floor. And something else happened right there. Something far more important than the chart. Someone big stepped in and bought the dip. Order books don't lie. When price slipped, massive bids appeared underneath the market. Not retail orders, not speculation. Structured, confident accumulation. That tells you everything. Weak hands sell strength. Strong hands buy weakness. And strong hands don't defend levels unless they expect something bigger next. Because they know who's trapped above them. Let's talk about the real losers here. Commercial banks, especially JP Morgan, have been structurally short silver for years. Paper silver, synthetic supply. Promises instead of metal. According to positioning data, commercial shorts control roughly 400 million ounces on paper. Now, do the math. Every $1 move higher costs them about $400 million. Silver moved $6. That's $2.4 billion in losses. On paper. But here's the part they don't want discussed. That loss assumes they can exit at current prices. They can't. If they tried to close even a fraction of those shorts at once, price wouldn't go to 70, it would gap violently higher. That's called slippage. The act of escaping makes the fire bigger, which means the real loss isn't billions, it's potentially tens of billions. This is why 65 mattered. Below it, losses were hidden. Above it, balance sheets start screaming. Risk managers wake up. Regulators ask questions. Liquidity lines tighten, and behavior changes. Instead of suppressing price, banks start quietly covering. They become buyers, unwilling buyers. The most dangerous kind. But the chart doesn't show the real crisis yet because it's happening somewhere else. The paper price says 65. Reality says 70. Industrial buyers don't care about charts. They care about delivery. Factories don't run on promises. If you're producing electronics, solar panels, medical equipment, running out of silver costs millions per hour. So when given a choice between waiting weeks at 65 or paying 70 today, they pay 70. That's the shadow price. It doesn't show up on CNBC. It shows up on invoices. And while banks fight over paper, physical silver is being vacuumed out of the system, which leads to the most dangerous trigger of all. Go check dealers. Premiums aren't falling, they're rising. That should never happen in a healthy market. Higher spot with higher premiums means one thing: restocking fear. Dealers don't know if they can replace what they sell, so they widen spreads, delay shipping, push pre-orders. Translation: the metal isn't there, and when physical supply dries up while paper claims remain, trust collapses. At that moment, contracts get settled in cash, not metal. Cash, and once investors realize their silver is just dollars with a silver logo, they rush to the real thing. That's when markets gap. That's when price discovery begins. That's when control ends. Now, zoom out. This isn't about silver going up. This is about fiat losing credibility. Silver isn't rising, the dollar is sinking. In 1980, silver hit $50. Adjusted for inflation, that's over $170 today. At 65, silver is still massively undervalued. Stocks are at extremes. Real estate is stretched. Bonds are broken. Silver is waking up from a 40-year suppression, and this is the part most people mess up. Volatility is coming. Violent swings, fake breakdowns. Headline fear. That's not weakness. It's the final psychological test. They want you dizzy, emotional, exhausted. Because weak hands sell movement. Strong hands sell nothing. Wealth transfers don't feel comfortable while they're happening. If silver drops $3 in an hour, that's not failure. That's pressure being released. Unless we break major structural levels, the trend remains intact. The squeeze doesn't end in a day. It ends when shorts are gone. So here's the real strategy, and this is the final payoff. You don't sell silver for cash. Cash melts. You sell silver for something better. Gold, land, cash flow assets. Watch the gold to silver ratio. When it compresses, that's your signal. That's how generational wealth is locked in without ever touching fiat. JP Morgan didn't lose $2.4 billion. They paid tuition for decades of suppression, and the bill just arrived. In the next video, I'll show you how banks attempt one last smash before capitulation and how to recognize it in real time so you don't fall for it. If you want the next move before it hits the headlines, subscribe, like, and share, because the squeeze hasn't peaked. It's just begun.